Date the rate, marry the home. You might have heard this phrase being used by a lot of real estate professionals. And the idea is simple here. If, and this is the most important part, if you can afford to buy a home at the current interest rate that it is right now, right? And you love that home, you want to get into a home, you can afford it, then go ahead, go and buy that home. Because interest rates, they go up and they go down, right? And so you can just simply wait it out until the interest rates go down, whether that's a couple months, couple years, and then you can refinance that original mortgage to the lower interest rate. But is it really that easy? Is it that simple to get a refinance? What is actually involved in that, right? So there's a lot more that goes into this simple saying. And to find out, you're going to have to watch this video. So first, let me welcome you to my channel, the MoveSmart community. My name is Lor Vang. If you haven't been here before, I'm a local realtor with eXp Realty and a loan officer with Nexa Mortgage in the greater Milwaukee area market. And I help consumers to make their next move a smart one. So in today's video, we're gonna break it down for you, right? What does this common saying mean? Does it actually make sense, right? Is it that simple? Should you buy a home and then refi later? Does that hold water? So let's get right into that. Let me break it down for you. Okay, so to start off, we're gonna first teach you about what exactly is a refinance, right? What is the refinancing process doing? So what that means is that you're gonna go get a new mortgage at the new current interest rate that's going on in the market, right? And you will replace your existing mortgage. So in theory, if the new current interest rate is better, meaning lower than what your original mortgage is, then your new mortgage is going to be more affordable. The monthly payments are going to be less than what you're currently paying. So far, that's, pretty simple, right? Now, here's the kicker. How easy is it to get a refinance? Well, essentially what happens is you have to requalify for a brand new loan. So basically, it is like requalifying to purchase a brand new home. So if you forgot how fun it was to get pre-approved to buy your home the first time, you're gonna have to do it all over again to requalify for a refinance to replace that current existing mortgage with a new one. So they're gonna start with pulling your credit to check your credit score. Your credit score has to be the same or ideally even better than when you bought your home the first time. So of course, 700 and up is good. Excellent would be 800 plus. That would pretty much secure you the lowest available interest rate that you can get. The next thing that they're going to look at is your income. It shouldn't be a shocker, but to some it might be. They want to make sure that you're actually still making some sort of income that can cover the new mortgage that you're going to be pulling out. So that also means that you need to still have a consistent job history. So you couldn't have too many gaps, right? Or periods where you stopped working or income stopped coming in. In addition, if you got a demotion or you lost your job and now you make less money at a new place, well, that might affect things for you because now you no longer make as much money as you did before. So those things can come into play with you qualifying for a new mortgage. All right, so let's say you pass the income check. Can you guess what they're gonna check next? If you guessed your debt, then ding, 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 you've won. So what they're gonna check to make sure between the time that you last bought that home and the time right now when you're applying for that refinance is to make sure that you didn't go out and rack up a bunch of debt on your credit cards or new lines of credit or loans, right? So for example, you didn't go and finance a bunch of furniture or appliances or bought one car or maybe two. So if all of a sudden your finances look really different because you have so much more debt now attached to your credit, attached to your name, it might be really hard for you to qualify to get refinanced if your DTI has grown substantially. And usually the limit for DTI is 50%. So you want to maintain or stay lower than that in order to ensure that you can be qualified for a refinance. Okay, so if those first three things check out, your credit score is good, your income is good, your job history has been consistent, your debt load has been good, you were well behaved, you didn't go out and over leverage yourself, right? Your DTI is good. Well, the next thing that the lender's gonna do now in order to get that refinance, they're gonna order a third party appraisal somebody that doesn't work for the bank or the lender. They're going to go out there to check the value of your home. So how they check that, if you've bought a home before, then you'll kind of understand. You should remember that they're going to look at the recent sales in the market that match or most similar to your home, right? And so that's how they're going to calculate what the value of your home is. So the problem could be if the market corrected, right, and the appraiser thinks that your home has actually lost value, that's going to hurt you. At the end of the day, it's going to hurt you. If they think that home prices have corrected and all of a sudden, you might have overpaid when you bought your home because it was a hot market, you had a bid high, and then all of a sudden the market cooled off. Things kind of a little bit corrected a little bit, right? Prices came down, values came down with it. So if that is the type of situation that you're in, it's going to be bad for you. You won't be able to get a refinance possibly, because especially if your home, if you think about it, if the appraiser says, oh, you're actually negative now, you're upside down, the value of your home is less than your current mortgage. That is a huge problem. So at that time, then you can't refinance. You have to wait. You have to wait until either the market goes back up or you pay down the debt enough where you can pay down your mortgage balance, right? So that you can refinance at that point. So that's something to think about. Another very important thing that homeowners should know is that the appraisal process for refinance is much different than an appraisal process for a purchase. So usually when you're purchasing a property, the appraiser has a contract in front of them, right? The purchase agreement contract. They know the price that the buyer is offering to pay for the home. So they have a target number to work towards, right? To justify that, okay, based on this purchase contract, what this buyer is buying this house for, I'm going to go out and I'm going to find some comps of similar homes that have recently sold and not too far away, kind of close in the same area. And I'm going to make sure, I'm going to see if this price that they're buying it is supported. And so because they have this target price, they know they have a number to work towards. But when you as a homeowner, you're doing a refinance, there is no number. The lender's not going to give the appraiser a target number. This becomes an art, an exercise for the appraiser to go out, look at recent sales, see similar properties in the neighborhood, right, that have sold. And now it is completely the appraiser's opinion based on those sales. Oh, what do they think your home's worth? So that is something very important. So usually appraisal for refis, they usually come in maybe a little bit lower than in a situation where you are going to go buy a home as a purchase. So just something for you to be aware of, okay? So be very conservative. Don't just assume that you're going to get a good appraisal on a refinance, because you might be shocked, is all I'm trying to say. Another thing to keep in mind for the appraisal is that the time between when you bought your home and what you've done to it, right? When you're trying to do a refinance. If you bought your home and you didn't do anything to it within a matter of a year or, less, and you're trying to do a refinance, the appraiser is going to ask you, what improvements have you done? Because they're going to be curious. What makes you think your home is worth more now between that short amount of time? So if you did absolutely nothing, then there's nothing to support additional value really, besides the market numbers. But if you did certain things like remodeling, right? If you bought a little bit of a fixer-upper and you remodeled the kitchen, you remodeled the bathrooms, right? You did good things. Maybe you might have added another bedroom. Who knows? Now you basically forced value into the home. So maybe when you bought it as a fixer-upper, you bought it at a lower price point than a home that would have been in, like they call it, cream puff condition, which means that, it's basically A1. It's the best top-of-line quality, right, compared to other similar homes, right? So if you bought a fixer-upper and you brought that home's condition up higher, now the appraiser's like, oh, wow, this home's beautiful. Yeah, I can see you put some work into this thing. Yeah, okay, I can see, you created value here. Yes, I see that. I'm going to give your home a little bit more money that you've created, right? You've created some additional value here. But if you bought a home that you didn't do anything, how can you justify it, right? So you have to prove, right, to the appraiser that you've increased the value somehow. And so you can't just rely on the market to bring your home's value up. Sometimes you have to force that value through remodeling or other things, right? Like adding a bedroom, something that wasn't there before. Of course, you should be doing these with professional contractors, licenses, permits, things like that, because the appraiser might ask. They might be asked, hey, did you do this professionally. If it looks like a hack job, you did it yourself, and you're not a professional and it looks ugly, it's not going to help either, right? So, some very important things to think about, okay? The final thing that a lot of people should be aware of when they do refinance is that it isn't free. So there is going to be a cost associated to it, and it can be pretty significant. It all depends if you've got the funds readily available to go. If you don't, then you probably can't make the refinance happen. So just like when you bought your home the first time, if you recall, there was a closing cost associated with buying that home. And so that could be anywhere from 3 to 5% is kind of the rule of thumb that we use roughly for closing cost. So if, say, for example, you were buying a $500,000 home, 3% of that is about 15 grand. And so if you're going to do a refinance, you may need to have $15,000 readily available to close that refinance loan. And in some situations, some lenders do allow you to roll that closing cost into your mortgage of that refinance loan. So meaning they're going to add that on top of your current existing mortgage, right? So not only they're going to pay off your first mortgage, but they'll add the cost of your refinance into that balance, right? So you're going to end up paying a little bit more, which may not be that big of a deal, right? You add $15,000, that's probably only going to be a difference of, maybe $20, $50, something like that, right? Depending on the rate. But essentially, at the closing table, you won't have to bring anything though. So you're just going to roll into the cost of the loan. So that would be an option for you that you could talk to your lender about. All right. So now that you know everything there is to know about doing your refinance, how that works, right? What's all involved. And it's not as simple as just dating the rate. You have to requalify essentially to buy a home again. And so the question that you're going to have now, is it worth it? How do I know? So we're going to talk about a couple quick points that you should think about in order for you to decide if it's worth it for you to do a refinance. One of the ways to determine if the cost to refinance is worth it is to do a break-even cost analysis. So what this means is you're going to look at the total cost to do a refinance compared to the monthly savings that refinance, that new mortgage is going to bring to you. So how long will it take you to recapture the cost of that refinance through the savings? So here's an example for you. So let's say that your refinance cost is going to cost you $18,000, for example, but your monthly savings is going to be $500 a month. That's pretty good. That's pretty significant, okay? So now, how many years will it take you to recoup that $18,000? So if you're saving $500 a month, times 12, that's going to be $6,000 savings per year, right? By doing the refinance. So now $18,000 is the cost divided by 6,000 per year. So if my math is correct, it's going to be 3 years. So 3 years for you to recapture the cost of that refi through the savings. And so for you, if you're going to still be in that home, you're still going to own it in the next 3 years or more, then yeah, it's probably worth it for you to do that refinance so that you can enjoy the benefits of those savings. Now, if you plan to sell that home in 5 years or less, or 3 years or less, definitely, then you may not want to pay to do that refinance, right? Why would you do that? That don't make sense. So this is one way for you to check the numbers, right? Check the math, make sure the savings are there and it's worth it for you to do it. The general rule of thumb for when you should start looking into doing a refinance is that when the new current interest rate is about 1% less than what you currently have. So usually when you start seeing that, then it's a good time for you to start thinking about doing a refinance, right? And looking into the numbers and checking and all that stuff. So that is a good rule of thumb. The other thing that you should be thinking about, whether a refinance is worth it for you, is how many years are you already paying in your mortgage? And realize that if you do a new refinance, replacing your current mortgage, basically you just reset with a new 30-year mortgage. Of course, you could do a 15-year refinance as well, but that may defeat the purpose of actually saving per month because a 15-year mortgage is usually more expensive than a 30-year. So something else to keep in mind if you're comparing 15 and 30, if that's what you're comparing. But realize that, hey, if you're already year 10 in your current mortgage, even though it's going to be more expensive that you're paying, if you do a refinance and you get a new loan to replace that one, well, now you're starting back over at year, 0 essentially, right? So you've just reset the entire schedule, even though you've already paid off a certain number of years already to begin with. So you have to decide, hey, is it worth it, right? So let me know, what do you think about that, right? Because there's some people who are of the refi until you die school, and then there's people who are, I want to pay off my home as quickly as possible, no mortgage free. So let me know in the comments, are you the mortgage free team, or are you the refi until I die team? So something interesting to think about. And then of course, the last thing that you should probably keep in mind when you're looking at refis, and even when you're buying home, don't chase the rate. If you're out there and you're thinking about refi and you just keep chasing to try and find the cheapest, the lowest rate available, realize, guys, that a lot of these mortgage companies, a lot of these lenders, they can promise you the lowest rate, and they can advertise the lowest rate and promise it to you, but you have to qualify to get it. And sometimes there's a cost to getting that rate as well. There could be bonus discount points that you have to pay, and that's even on top of the refi cost. So that's additional cost. And then maybe sometimes you don't want to pay the additional cost, right? Maybe there's some other things that you need to do in order for them to incentivize you to get that lower rate, such as, oh, you got to open an account, or whatever, right? You got to escrow things into your mortgage payment in order for it to get a slightly lower rate. So there's all these little fine print things that you should be aware of. And then lastly, of course, is the customer service, right? The speed. Can they actually close the loan? Can they close that refi for you, right? There's no point in chasing the lowest rate if that lender, they can't deliver. Okay, so now you have a much better understanding of the concept behind marry the home and date the rate. And now you should be able to see that it's not as easy, not as simple as it sounds. There's quite a lot of work involved to date that rate, right? And to find a new rate. So now you know how to do it and if it's worth it for you. So if you are thinking about refinancing, you need some help with that. You need some pricing, right? If you're in Wisconsin, California, Minnesota, feel free to reach out to me. I can help you in those states. If you have any other questions, drop them in the comments, reach out to me. I'd be happy to help out if I can. Thank you so much for watching. If you found value in this video, please help me out. Hit that like button, hit that subscribe button so that you can be alerted of future videos just like this one, and it helps to put it out in front of other people who need to get this information right. So thank you so much for watching. I will see you in the next video. Peace.